Hello world, welcome to Farm the Market. Today I want to share with you some of my thoughts regarding the strategies that involve selling options. In particular, the famous cash secure put and the wheel strategy for that matter. I have watched many videos in the past couple of weeks that talk about these strategies, and I have watched videos that span from, since maybe 2020 to even a couple of weeks ago. So I think I have a good sample of what, in general, YouTube presents to the public, the creators present to the public of what these strategies are and what they can do. And well, my first takeaway from watching so many videos is that a lot of people try to sell options in general like some sort of mythical creature. What do I mean by that? They try to give you the idea or the notion that options are this magical or mythical instrument that will never lose in the markets. As long as you do A, B, or C steps over and over again, you will have no risk and you will be able to make money every time. Of course, that's not true. And I'm sure you have seen some of those videos. Usually the thumbnail looks something like this, where you have, a smiley guy uh, tout, giving you the impression that you can have either a weekly income of a good amount of weekly income, and especially constant weekly income. That's what they usually talk about. Or that you can have 100% winning strategy, or 90%, 85, whatever, a very high percentage. Or that you can have a very high return in terms of profits. And the catch usually is that you just have to do something that looks at first glance very easy, and you just have to do it over and over again. For example, the strategy of selling cash secure puts. And you don't need to worry, because if you get a sign that it's perhaps the biggest risk when you do this strategy, well, that's not a problem either. You just have to sell now covered calls over and over again, and eventually, you will get to the other side of the trade and you can start selling puts again. And I'm sure you have heard about this. This is what is usually referred to as the wheel strategy, the mighty wheel strategy. That the basic idea is that you can do this forever and never lose money. And well, of course, that's not the case. I would like to point out that I am not saying that you cannot have a good return selling options. Actually, I'm a big fan of selling options. I think there's a skew in the market, so to speak, that gives you a little bit of an edge when you're on that side of the trade. But that doesn't mean that you can just do a mechanical trade over and over again without any other modifications or tactics and expect to make money consistently, and especially take no risk. That's something very important. You're always taking risk, okay? So whenever you hear someone or is trying to tell you that, oh, don't worry, do this because you're not taking any risks, that's a big red flag, okay? So the typical strategy involving the wheel, as I said, it's just a cycle where you are mechanically, or at least that's what they want you to believe, that you can just mechanically over and over again, just like a machine, sell cash secure puts or sell covered calls, depending on what's going on with the underlying stock, and eventually everything will even out and even give you, of course, a profit. So the first approach is always, very thinking like it's some sort of a staircase, where you don't have to worry, because eventually the staircase will keep going up, and you can the Goldilocks scenario will make you money in the long run. However, this is not exactly how the markets work, and of course, as they always say, the devil is in the details. So, from a top-down view, if you take this very simplistic approach, you could say, well, it makes sense, it sounds reasonable, and I'm gonna try it out. And it's when once you start trying it out, and that you find out that, well, you can get in big trouble. So, which are some of the dangerous assumptions that are made when you take this simplistic approach to what this strategy can give you? Well, first of all, you're assuming that the stock will always recover. Even if the stock crashes or has a drawdown, it will always go up again. For example, using this simplistic chart, after this drawdown, we will assume that the stock is going to go up again, and well, we can just keep doing this over and over again. Another assumption is that we can always get good premiums. What I mean by good premiums is that regardless of the strike and the spot, we can always get a decent premium. And of course, that's not the case. Depending on what's going on in the market, there may be occasions when you will be so far away from the spot price. I mean, your original strike will be so far away from the spot price that there are no premiums there. I mean, there are no market makers don't even quote prices for those options. So there will be periods of time when, the strategy simply cannot work because there are no bids to go out and sell the options. Another assumption is a lie. This has happened to me, and I think this has happened to any trader who has traded short puts. When you get assigned, it's very tempting to go the way of, I wanted to hold the stock anyway, so I'm fine. Everything is fine. So, that's a lie that we tell ourselves, because if you really want to hold the stock, and I think people that do use these kind of strategies, that's maybe like the 1% that really want to hold the stock. And if you really want to hold the stock, you wouldn't even be thinking about the wheel, because it wouldn't make sense to sell covered calls on a stock you think has a bigger potential to the upside. So it doesn't make much sense. This is just a lie we tell ourselves, to feel more comfortable once we get assigned. And of course, the mythical power of options. There are thousands of ways of rescuing a trade, according to most of the videos I watched. And of course, well, this is just a pretext to avoid taking a loss. So these are some of the assumptions, again, that I think are dangerous, and most people make when they are trading this strategy, especially when they are new to the strategy. In reality, the market will move not as a staircase, but it will move up and down in a more random way. And eventually the Goldilocks scenario, well, it won't be as nice as we thought. So as I said, I like selling options. And for example, the wheel strategy, I think it can be a very viable and very good strategy, but at certain times. For example, inside this purple rectangle, this is a very simplistic chart, but I think the idea, I think it conveys the idea that this strategy usually works when you have a market that is moving relatively sideways or maybe upwards, but not in a very steep fashion. So if we stay in this purple rectangle, we have, for example, we assume we have 7 trades in this rectangle, and we're selling cash secure puts. We get assigned. We're able to sell covered calls with a decent premium, even though the stock is going down, and it eventually bounces back up because it's moving within this range, and we sell a cash secure put again. So, for a scenario like this, I think the strategy is pretty decent, and it can actually be a good alternative to a just traditional long setup for a stock or an index or an ETF or something. However, this is not what happens all the time, and that's kind of the catch of thinking about this mechanically, because if you think about this mechanically and repeating this over and over again, regardless of what's going on with the underlying stock, well, that's when you get into trouble, because what happens if the stock starts to take off, for example? Like if we look at this red box, the stock is no longer within a range or moving upwards, at a steady pace. It's starting to go a little bit exponential. So when this happens, usually we're starting to get smaller premiums. So, the stock rise overshadows the premiums collected. What do I mean by this? If you were long the stock, when the stock is bouncing around, it's going really nowhere or going upwards in a slow fashion, you are not really leaving a lot of money in the table by taking premiums, and maybe you're even reducing the volatility and stuff like that of your position. But once the stock starts to go up, let's say by increments of 10% every maturity of your cycle of options, well, if you're collecting a premium of, let's say, 2% each time, the difference starts to show. So maybe, for example, assuming 1, 2, 3, 4, 5 trades in a row, if you collect 10% premium, once again using a simplified example of 2% premium each time you sell a you sell a put. During this interval, the stock maybe went up 40 or 50%. So the difference starts to notice. So, and also, I don't have exact numbers because this is just a simplified example, but what will usually happen is that as the stock starts to go up, implied volatility will drop. So it's not only the spot price that is getting away, but also the premiums you receive will, all else being equal, will be smaller every time. So you're getting to a point where you're getting the famous collecting pennies in front of a steamroller example. So this might not be the best time to be using this strategy. And once again, if you are doing things mechanically without considering what's going on with the market volatility, the stock price, even the skew in the options chain, etc. Well, you might be getting into a period where it's not so advantageous to be doing this strategy, and this would happen with most people. A lot of money comes in when things are easy. When the stock is going up, well, maybe the premiums go down a little bit, but I'm still collecting a nice premium. But eventually, when sorry. But eventually, when the stock drops, well, we're left in a position when now the opposite is happening. Maybe the implied volatility is going up because the stock is going down, but the spot is moving so far away from our strikes, original strikes, that we cannot sell covered calls there. So the strategy is, we went from a period of bonanza, let's call it, to a period where, it wasn't paying that much, well, it was still working. And now we are going into a period where we cannot even continue the strategy. We are receiving 0 premiums in as time goes by. And since we are long the stock, our valuations keep going down as the stock goes down. So what happens here is that you become what is usually referred to as the infamous involuntary investor. Once again, you lie to yourself, so to speak, and you say, oh, it's okay, I'm going to hold because it's going to come back. And something that was supposed to be a trade becomes an quote-unquote investment. And well, that never goes, that never has a good ending, at least in my experience. So don't fall for that trap. Options are not, special. Options are not going to keep you safe no matter what. Options are just another instrument that gives you exposure to the markets. And in that case, as with any other strategy, you have to set always a stop loss. There has to be a point where you get out. The advantage of this kind of strategies is that usually, especially if you trade, small deltas, you can have a lot of easy wins, so to speak. But the market will eventually come around and it will start to move the other way. So you have to be aware that, yes, you will have a lot of small wins, so to speak, but be prepared to take also a few big losses. And it's always better to have a stop loss than to just let things go, go wild, so to speak. After all, and this is something that is prevalent in these videos that I've been watching, they always talk about, don't worry, you can always roll or defend or manage or whatever term you want to use, to work around what's going on with your losing position. But, if we are honest with ourselves, the translation for that is that most of the time, 99% of the time, all we are doing is we want to avoid pain. We want to avoid taking a loss. We want to avoid admitting we were wrong. We want to avoid admitting that the strategy doesn't always work. And that's the real reason why we're doing this rolling or defending or managing or whatever you're doing. Now, I say most of the time because, as I said, I like to trade options and usually sell. I do a lot of short option strategies. And sometimes it's worth doing something to the position, whether you want to call it managing or defending the position. Sometimes it makes sense. Again, that's the exception to the rule. I will say mostly the rule is you just have to take your loss and don't be worried about just being wrong or avoiding the pain. So keep that in mind whenever you are starting to get into a losing position. What are you really doing? Are you really doing something that makes sense? The numbers really make sense, or you are just trying to avoid pain? Let's see a quick example here about what we usually tell ourselves. I'm gonna pick two random stocks, sort of speak. I'm not recommending or saying these stocks are good or bad. Are just two general examples that I think will help us for what I'm talking about. So let's say I find a fundamentally strong stock, but I'm lazy. I didn't make any research, so I just say HP is a fundamentally strong stock because Warren Buffett owns it. So that's the only reason I'm using it for this example as the fundamentally strong stock. So if I want to do the wheel strategy, I already found a good candidate because this is a good stock that has go down pretty much almost 33% during this year. So it has dropped like the rest of the market. And on the other hand, I'm tempted, although I have already looked into HP and it's quote unquote a fundamentally strong stock to start the famous wheel strategy. I read a tweet or watch a video or something where someone is talking about NEO, for example. NEO, of course, has a higher implied volatility than HP. It has also dropped during 2022 significantly, around 45%. So I'm starting to get into my mind the idea of, well, HP sounds nice for the wheel, but let's take a look also into NEO because, higher vol means higher premiums and, we'll want to make a lot of money. So it might be interesting. So what do? We try to rationalize what we're doing. We're moving from the general idea of looking into a fundamentally strong stock like HP, and we say, okay, let's say I want to look at the next monthly expiration, and for HP, I can sell, let's say Delta. It's my basis for the comparison. I'm looking for a Delta close to 20. So for HP, I can sell a put for about 40 cents premium, that in this case is around a 1.7% return for 23 days. So that sounds okay. I can also see, to confirm my bias, that right now the implied volatility is a little bit higher than the usual historical volatility for the stock. So, so far so good. Then I look into NEO, and well, for a similar delta, I can get about twice as much premium, in a percentage basis, because it's not the same. It's not the same strike, of course, but in a percentage basis, it's very close. Also, I can go a little bit further out of the money, so that gives me a little bit more of certainty, so to speak. And of course, the implied volatility is higher. That's why the stock looks the premium is higher too. So I compare the two and I say, well, I know the strategy implies that I have to buy a stock I would like to hold and that it's fundamentally strong. But I don't see much of a difference if I do the same trade but with NEO. And after all, I wouldn't mind owning NEO. And that's where we fall for the trap, a stock you wouldn't mind owning. So I just wanted to make this quick example because this has happened to me many times, and I'm sure this has happened to you, but it's something that you have to be aware of because there's nothing wrong, let me repeat that, there's nothing wrong with selling options in a more volatile stock. I mean, it's perfectly fine. I mean, if you manage your risk and that's part of your strategy, that's okay. What I'm trying to point out is that don't lie to yourself. Don't justify that you are doing something, that you're trying to do the wheel strategy, let's say the traditional wheel strategy, when you're not. You're taking more risk, you're going for higher premiums, that's fine. But don't fool yourself that you are doing something different. That's what I'm trying to get to. Another point I want to go over is about the deltas, because in many of these videos, and I referenced delta in the example we just watched. They will tell you that delta is basically the probability that the option will expire in the money. And as a rule of thumb, that's fine. And that's, if you do the numbers, it's a ballpark number. So that's not my problem. My problem here is that many people use this to give or to get a false sense of security, and what you tell yourself usually is, oh, okay, so if I trade very small deltas, if I go way out of the money, I will basically never get assigned. And that's where most of the time people come up with this, oh, get a 100% winning strategy. Because if you have a very small sample size and you trade very small deltas, it's very easy that you will get a 100% winning rate because your sample size is very small. The problem is what happens when you expand that sample size and you start getting those big losses, as I talked about. You usually get a lot of small wins and then come the big losses. So that's the part that most people leave out on their videos. So I want you to be aware of that. And also, I would like, as a matter of context, I would like you to think of delta also in a different way. What if you thought about delta as an estimate of the number of stocks you are already long or short whenever you sell an option? Okay, you might say, well, that doesn't make any sense. What are you talking about? I have been told over and over and over and over that delta will just tell me the probability of being right or wrong at the end. Okay, as I mentioned, that's a good approximation. But in terms of context and in terms of what I want you to realize about what you're doing when you sell an option, I want you to think of delta, again, as the estimate of the number of stocks you are already long or short. You might say, well, I'm not long or short anything. I'm just playing with the probabilities. I think I have an edge. So, if I do this over and over and over, I will be fine. I'm just playing with the odds and I have an edge and everything will be fine. I'm not long, I'm just short. I'm not long any stock. I'm just short an option, especially when I sell a put, for example. So going back to the NEO example that we just looked at, I would like you to consider this. If you sell a put option today on NEO with a delta of around minus 21, if you were a market maker, to hedge that position, you will have to sell 21 NEO shares per each option you are short. Okay, that's what is called delta hedging, and that will be, you can never be perfectly hedged, but that will be the closest you can get at that moment to eliminating your directional exposure. So if you are not doing that, if you are not doing delta hedge, the equivalent position is that, okay, you receive the premium, but you are long the shares. In this case, around 21 shares for every put option you sold. So I want you to really think about that, because I think that if you think of your position in terms of what are you long or short shares wise, that will help you to understand why it is very important to look at your risk-reward ratio and your attitude, especially towards using or not the stop loss. Because if you always come from the assumption that is almost never you will get assigned, and it's very easy to get quote-unquote free premiums every week or month or whatever, the risk side of the equation is usually neglected. So I use this example to try to put into simpler terms, as if you were in a regular stock trade where you are short of long. And of course, this will magnify as the stock moves. Because, for example, let's say a few days go by and the delta increases. So the option gets in the money. Now your delta is 62. So if we take again, in this assumption, at this instant, at this point in time, you're no longer long only 21 shares. Now you're long 62 shares. Okay, so your position is getting closer and closer to being, even you still have almost 20 days to expiration, your position as the delta increases is getting closer to being long the stock. And well, of course, if a few more days go by and the option gets deeper in the money, well, it will be, in this case, if we assume a 92 delta, you're already 92 shares long. So it's basically like if you have already been assigned. So what are you going to do at this point? Forget about the option for a moment. if you were long this position of stock, what would you do? And that's the point I'm trying to transmit here. So I hope that made sense. I hope that different perspective on what's your exposure when you are short an option helps you to really, especially get into context, this risk-reward relationship, and of course, the importance of having stop losses. And finally, just as a conclusion, sorry, I would like to mention that regardless of what's your strategy, you always need an edge. Of course, that's really hard to define. What's an edge? It can take many ways, shapes, or forms. But the idea is that if you just copy-paste a strategy that you see in a YouTube video, and you do no tweaking at all, you do not add any layers to it, you do not add any of your expertise, so to speak, to the strategy, you cannot expect to make money, if you only copy paste a strategy that you see in a YouTube video. You have to add something. It could be, a good starting point. It could be, especially I would say, whenever you encounter one of these videos, and also in my video, don't take everything for granted. This should be a starting point for you to start asking questions and investigating more about the mechanics, the numbers, how things work, how the option price moves, etc., etc., etc. And around that, and with trial and error, and being, of course, risk aware, you can start building a strategy. But please, 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 don't ever think that you can just go into a video or an article or a blog or whatever and just say, oh, for whatever reason, this guy decided to share for free a strategy that will make money. I mean, come on, be realistic. That doesn't exist. So it can be a good starting point, and especially if you're new to trading options. But always ask questions and be kind of a cynic. Don't think that things are just what they seem to be. And of course, especially with clickbait videos and stuff like that. Well, I'm starting to rant a little bit, but I think you get the idea. So I hope you enjoyed this video. In case you have any comments about what I mentioned, if you agree, disagree, or if you have another point of view, please comment in the section below. And well, as always, please remember to like, subscribe, turn on notifications, and all that good stuff. And well, thanks for your time. Have a good one.